We now need to prepare the journal entries, general ledger accounts, and statement of comprehensive income using absorption costing. And please note the only difference between the two is with variable costing, we expense the fixed manufacturing overheads as a period cost. On the other hand, with absorption costing, those fixed manufacturing overheads are going to be included in inventory valuation. So with absorption costing, we include both our variable production costs and our fixed production costs in the value of inventory. So once again, let's start by just taking the balances that we have in the question and putting those on our general ledger accounts. So for finished goods inventory, please make sure you are looking at the correct balances for absorption costing. There's my opening and my closing balance. And we also had a balance over here for direct material inventory at the beginning of January for 10,500 Rand. So here are my general ledger accounts for absorption costing. Raw material inventory, remember that is an asset. We have an opening balance of 10,500 Rand. And for finished goods, this is also an asset. We have an opening balance of 10,000 Rand, and we have a closing balance of 29,300. All right, so that deals with all of the balances. We can now look at our transactions. Now, the majority of our journal entries are going to be exactly the same as what they were for variable costing. The only difference will come in when we get to our actual fixed manufacturing overheads, because we won't expense the cost, we will include it in inventory valuation. So the first couple of journal entries are exactly the same, so I'm going to go through these really quickly. We purchased raw material inventory to the value of 90,000 Rand, and 97,000 Rand was issued into production. So when we buy raw material inventory, we debit our raw material inventory. And we credit accounts payable or bank. And that was 90,000 Rand. Then when we issue the raw material into production, we take it to work in process. So we debit work in process. And we credit raw material inventory. And that was 97,000 Rand. So let's record those in our general ledger accounts. So remember, this work in process is also an asset. It's a category of inventory. We then need to record the direct labor wages and also the admin salaries. So for the direct labor wages, we debit our wages control accounts. And we credit bank. For the admin salaries, we debit our admin salary expense. And credit bank. So go to your general ledger accounts. Here's my wages control account. Once again, this is a control account, so it must balance to 0. Your admin salaries just below. This is an expense account. Then please remember, for our direct labor cost, we need to take that to work in process because it must be included in inventory valuation. So we clear out this control account over here so that it balances to 0, and we take this to work in process. Let's just record that journal entry. Then next we need to deal with these fixed manufacturing overheads. Now please remember from our lecture, we dealt with fixed manufacturing overheads in 4 steps when you have absorption costing. Because remember, in terms of IAS 2, fixed manufacturing overheads need to be allocated to production based on normal capacity. So let's work through those 4 steps now. In step 1, I told you at the beginning of each year, you are going to have to calculate an allocation rate. And because we are performing this calculation at the beginning of the year, we don't have actual information available, and we are forced to use budgeted information. So we are going to take our budgeted fixed manufacturing overhead, and in terms of IAS 2, we need to allocate fixed production costs to the value of inventory based on normal capacity. So go back to the information provided in the question. The budgeted fixed manufacturing overhead for 20X8 is 3.6 million rand, and their normal capacity is 36,000 units per annum. So this gives me an allocation rate of 100 rand per unit. Then in step 2, we calculate our absorbed overhead. And remember, we perform this calculation by taking the allocation rate from step 1 and we multiply by actual production. And the logic over here is, we calculate this allocation rate at the beginning of the year so that we can include our fixed overheads in the value of inventory. So every time we produce a unit, we will include 100 rand in order to cover our fixed manufacturing overheads. So every time 1 unit is produced, 100 rand is allocated. So we take that 100 rand allocation rate and we multiply it by actual production so that we can see what we are actually allocating to the value of inventory. So actual production for the month of January was 3,490 units. So we have an absorbed cost here of 349,000 rand. So every time 1 unit was produced, we allocated 100 Rand in order to cover our fixed manufacturing overhead. So we ended up allocating 349,000 Rand to inventory. Then at the end of the month, we will know what our actual fixed manufacturing overhead cost is, and we should then calculate our variances. And remember, first we calculate our expenditure variance. And the expenditure variance is just the difference between the budgeted and the actual cost. And we also calculate a volume variance. And the volume variance is the difference between the budgeted cost and the absorbed cost from step 2. So if we look at these calculations, the actual fixed manufacturing overhead for the month of January was 313,200. And we know that the budgeted cost for the entire year is 3.6 million Rand. So please note, you must just be consistent over here. This actual cost is the actual cost for 1 month, only for January 20x8. So the budgeted cost must also be the budgeted cost for 1 month. So we are going to have to say 3.6 million is the budgeted cost for the year. Divide that by 12 to get the budgeted cost for 1 month. So the budgeted cost for 1 month is 300,000 Rand. So we have a variance here of 13,200, and this variance is going to be unfavorable because our actual cost is more than the budgeted cost. The budgeted cost over here is 300,000 Rand. So please remember, if we have an unfavorable variance, this is going to be treated as an expense on my statement of comprehensive income. Then for the volume variance, we take that same budgeted cost for the month of 300,000 Rand that we calculated above. The absorbed overhead from step 2 is 349,000. So here we have a variance of 49,000 Rand. And we need to determine whether that variance is favorable or unfavorable. And you'll remember I told you, you can't look at the Rand values. This is a volume variance, so you need to look at your volume. So if we go back to the information provided in the question, they actually produced 3,490 units in January. What is your budgeted production for January? Well, normal capacity for the entire year is 36,000 units. So if we divide that by 12, it means their normal capacity or their budget for 1 month is 3,000 units. So they budget to produce 3,000 units. They actually produced 3,490 units. So they actually produced more than what they budgeted, meaning we are sitting with a favorable volume variance. Remember, another way that you could have looked at this calculation is you could have taken your actual production volume of 3,490 units less your budgeted production volume or your normal capacity of 3,000 units and multiplied that by the allocation rate of 100 Rand per unit from step 1. And that will also give you an answer of 49,000 Rand. And once again, this is going to be favorable because we actually produced more than normal capacity, or we actually produced more than what we budgeted to produce. And remember, if we have a favorable variance, that is going to be treated as income in my statement of comprehensive income. All right, so when you are dealing with absorption costing and you have to allocate fixed production costs to the value of inventory, always work through those 4 steps first. Once you've worked through those 4 steps, we can now look at recording these transactions in our general ledger accounts. Okay, so let's continue now with our journal entries. Where did we stop? We start with journal entry number 5. So we are now sitting on journal entry number 6. And first we are going to record the actual fixed overhead cost for the month, where we are going to debit our fixed overhead control account. And we are going to credit either accounts payable or bank. And this is with the actual cost for the month. So the actual cost was $313,200. So go to your general ledger accounts. Here's my fixed overhead control account. Please note this is a control account, so it needs to balance to 0. We debit our fixed overhead control account. We credit accounts payable or bank. With the actual cost. Now, I already said to you, this is a control account and it needs to balance to 0. So because this is absorption costing, we also need to include any fixed manufacturing costs in the cost of inventory. So we need to take this now to work in process. So let's look at that journal entry. The fixed overhead is going to be included in inventory valuation, so we take it to work in process, and we take it out of our fixed overhead control accounts. Now please note, this is probably the most difficult journal entry in this entire tutorial. What you take to work in process is always the absorbed cost. The absorbed cost that we calculate in step 2, you'll remember from our lecture, this is what gets included in inventory valuation. So that is taken to work in process, $349,000. And what do we take out of our overhead control account? We take out the budgeted amounts. So the budgeted cost for the month of January 20X8 was 300,000 Rand. And your balancing figure over here is going to be your volume variance. So you'll remember above, we calculated a favorable volume variance of 49,000 Rand. So you'll see in order to balance this journal entry, we need another credit over here of 49,000, and then this journal entry balances. That is your volume variance. Which is going to be taken to profit and loss. And please note, we are crediting profit and loss with that volume variance because it is a favorable variance, meaning it is income in our statement of comprehensive income. So it's a credit to profit and loss. So let's look at this journal entry over here on our general ledger accounts. We said we are going to take the absorbed cost to work in process. So we debit work in process with the absorbed amount of 349,000. So we debited work in process with the absorbed amount of 349,000. We credited our fixed overhead control account with the budgeted cost of 300,000 Rand. And then the balancing figure in our journal entry was a credit to profit and loss. So here's my profit and loss. Credit your profit and loss with your volume variance of 49,000 Rand. Okay, so make sure you've dealt with all components of this journal entry. We debited work in process with the absorbed cost. we credited the fixed overhead control account with the budgeted cost, and then we credited profit and loss with the volume variance. So that journal entry balances. Then in our next journal entry, we need to record the expenditure variance. Now the expenditure variance was also just calculated above. We have an unfavorable expenditure variance of 13,200 Rand. So remember, an unfavorable variance is going to be an expense in our statement of comprehensive income. So we are going to debit profit and loss with our expenditure variance. And the credit goes to your fixed overhead control accounts. So let's look at this in our general ledger accounts. We credit the fixed overhead control account with 13,200. You will now see that this account balances to 0, which is exactly what we wanted. We said this is a control account, it must balance to 0. So your expenditure variance is actually just your balancing figure on this account. So we credit the fixed overhead control account with 13,200 and we debit profit and loss because it is an unfavorable variance with 13,200. Then let's wrap up these general ledger accounts. For raw material inventory, we are going to have a closing balance of 3,500 Rand at the end of the month. Our wages control account balances to 0, which is perfect. For admin salaries, we have an expense of 52,000 Rand. Our fixed overhead control account balances to 0. We have a balance sitting in work in process. However, please remember in this question we were told that the company does not hold any stock of incomplete inventory. So any balance sitting in work in process needs to be transferred to finished goods. So make sure that this account balances to 0. You're going to debit your finished goods inventory and credit work in process with 586,000 Rand. So let's just record that journal entry while we are here. Then we know our closing balance over here for finished goods, so we can work backwards in order to calculate what must be transferred to cost of sales. Remember, cost of sales is also just an expense account. So what is this balancing figure over here in order to make sure that we have a closing balance in finished goods inventory of 29,300? This is going to be 566,700. So we can look at our final two journal entries. When the company sells inventory, they process two journal entries. One for the sale, where we debit bank or accounts receivable. And we credit sales. So for the month of January 20X8, we had sales of 650,000 Rand. And then at the same time, we also debit cost of sales and credit our finished goods inventory so that we can record the expense in the same period that we record the revenue. So we match our expense to the same period where we recognize the revenue. And that comes from our general ledger accounts. We calculated the amount, 566,700. All right, so we've completed all of the journal entries and the general ledger accounts. We now just need to complete the statement of comprehensive income. And once again, let's first write out the format and then we can plug in all of the numbers. We start with sales. We then deduct cost of sales. We calculate cost of sales by taking opening inventory, and then adding all of our production costs. We are looking at absorption costing, so both my variable and my fixed production costs. So I'm going to bring in my raw material purchases, my direct labor cost, and also my absorbed fixed overhead. We then deduct the value of closing inventory to give us cost of sales. Then please remember, before we calculate gross profit, we need to take those variances into account. So the expenditure variance and the volume variance. After taking those variances into account, we can calculate our gross profit. And then we need to deduct any other non-manufacturing costs. So the only other cost that we had in this question was the admin salaries. And that will give us our net income. All right. So sales for the month of January 20X8 was 650,000 Rand. For opening inventory, go to your general ledger accounts. There's my opening inventory for raw materials and my opening inventory for finished goods. And then for both of those, we also have closing balances that we need to take into account. Then for raw material, we purchased 90,000 Rand worth of raw material. Remember, you bring your purchases in over here because we have our opening inventory plus our purchases minus my closing inventory will give me what I actually issued into production. So the actual 97,000 Rand that was issued into production, That is the net effect of all of those transactions. Then for direct labor, we have a cost of 140,000. And for your fixed overhead, remember, it's the absorbed amount that goes to cost of sales of 349,000 Rand. So the easiest way to remember this is go to your work in process account. All of these amounts that are taken to work in process are included in the value of inventory. And it's these amounts over here that go to cost of sales. So the raw material that we take to cost of sales is 97,000. The direct labor is 140,000, and the fixed overhead is 349,000. So all of that goes to cost of sales. So we can then calculate our value for cost of sales. And again, you will see that ties into the cost of sales that we calculated over here in our general ledger accounts. Then we need to take into account these variances, our expenditure variance and our volume variance. Remember, the expenditure variance was unfavorable, so we need to treat that as an expense in profit and loss. The volume variance was favorable, so that will be added back as income. We can then calculate our gross profit. Admin salaries for the month were 52,000 Rand, and calculate your net income. All right, so that deals with part A of the required. For both variable and absorption costing, we've prepared the journal entries, the general ledger accounts, and also the statement of comprehensive income. We now need to reconcile the net income according to the two methods. So please remember, as per our lecture, if we need to reconcile the net income, we start with the net income that we calculated using absorption costing. We then add any difference in opening inventory. We deduct any difference in closing inventory. And that will leave us with our variable costing net income. So go back to all of your previous calculations. With absorption costing, there's my net income. For variable costing, there's my net income. So that's what we are trying to reconcile. And in order to reconcile the two, we just take the difference in opening and closing inventory. So here's my opening and closing inventory for absorption costing. And here's my opening and closing inventory for variable costing. All right, and we've reconciled the difference between the two. That then brings us to the end of this tutorial question. Please let me know if there's anything you're still struggling with. Thank you, guys.